Welcome. In this video, we are going to know what is tax, what is cess, and what is surcharge, and we are going to know the difference between these three. So first, let us understand each of it, and then we will go into the differences between them. So first, let's see what is a tax. Tax is something government collects from you, either directly or indirectly. First, you will see how government collects money from you directly. Let's say you are earning a certain amount of money, so you have certain income. So we all know you have to pay income tax. So this is a way in which government is directly taking money from you. From whatever income you are earning, you have to pay a certain percentage of that money to government. If there is a company, instead of an individual, if you take a company, that company, whatever profit it earns, out of that profit, a certain percentage of that profit should be given to government. That is called corporation tax. So in case of individuals, it is income tax, and in case of companies, it is corporation tax. So these are directly levied on individuals or companies. There is another way in which government can collect taxes, that is indirect tax. So this is, for example, when you go and purchase some good, you pay the price of the good as well as some extra, some 5% or 10% or 12% of some amount of money, which will not go to the seller, but it will go to the government. So here the seller will deposit that money to the government, not you directly. In case of income tax or corporation tax, individual companies directly giving the money to government, but here indirectly you are paying to government by purchasing something or by eating at some restaurant. You will purchase the service of the restaurant, along with it you will pay some extra money to government. And this money, like for example, if you go and eat at a restaurant, you will pay for whatever you have eaten, and along with that, let's say 5% extra you are paying. This 5% extra will be deposited by the restaurant owner to the government. So indirectly you are paying that money to the government. So this is an indirect tax. So GST is a very good example for indirect tax. There are some other indirect taxes also, excise, VAT, etc. So what happens once the taxes are collected? What happens? How the government can spend it? Let's say government has collected X amount of money. This X amount of money, what happens is, government cannot spend all the X amount of money as it wishes. Our constitution mandates it to give from this X amount of money, certain amount of money to state governments. Let's say in this X amount of money, certain percentage of money should be given to state governments. So now the latest rule is 41% of the amount, whatever central government is collecting as taxes, should be given to states. So this 41% of tax is distributed among states. So how much is left? They are left with 59% of tax. So this is the amount in which central government can spend as per its wishes. So this is central government's paisa. If central government is collecting X rupees as taxes, in that X rupees, central government cannot spend X rupees all by itself. It has to give some amount of money to states, and then whatever is remaining, only that central government can spend. So who decides how much of percentage should be shared with states? This is determined by Finance Commission recommendations. There is a separate commission called Finance Commission which looks into everything and which tells central government, which recommends central government how much should be shared with states out of all the taxes that central government is collecting. So how it happens is, let's say central government is collecting 100 rupees. Out of it, only 59 rupees central government can spend for itself, or whatever it wants to implement, it can implement only with this 59 rupees. Even though central government is collecting this 100 rupees, out of it 41 rupees is going to states. Which states? It will go to all the states, but unequally. So let's say in this 41 rupees, 2 rupees are going to Kerala, 3 rupees are going to Andhra Pradesh, 4 rupees are going to Telangana, 10 rupees are going to Uttar Pradesh. Like that, all these states, they will share that 41 rupees, 41% of whatever central taxes are coming. Again, all these states will share. So this arrangement is called vertical devolution. Like whatever central government is collecting, it is giving to states. This is called vertical devolution, and this arrangement is called horizontal devolution. So if government is collecting 100 rupees, it has to give 41 rupees to states. This is called vertical devolution. And out of this 41 rupees, states will be dividing this money according to the needs. Like if UP has more population, it will get more money. So like that, there are certain parameters. Who will decide this? How much each state will get? This is again decided by Finance Commission. It will recommend to central government, and central government will distribute the money accordingly. So this is how it happens. We have learned what is vertical devolution and what is horizontal devolution, and how taxes are shared between central and state. Now, so whatever central government collects from you as tax, it has to be shared. But in this case, what is happening is central government is collecting 100 rupees, but it is able to spend only 59 rupees out of it. So now central government doesn't want this kind of arrangement. Central government wants more freedom. So what it does is, instead of collecting in the name of tax, it will collect money from you in the name of surcharge. So when central government collects money from you in the name of surcharge, there is no mandate on it to to give it to states. There is no need to give surcharge. There is no need to distribute surcharge to states. Like if central government is earning 100 rupees as taxes, and central government is earning another 20 rupees as surcharge, these taxes, after giving states share, only 15 rupees central government can keep it with itself. But this surcharge, entire surcharge, central government can keep it with itself. So this is why along with charging taxes, central government will also charge surcharges in some instances. Like say for example, if a company earns profit more than 10 crore, then there is a rule that along with whatever applicable income tax they are paying, they will pay some 5% surcharge. Okay, so here this income tax is shared by central government and state government, but this surcharge is not shared. So this is the main difference between tax and surcharge. Understand the difference between tax and surcharge with one more example. Let us say you are purchasing a luxury car it's a luxury car item worth 50 lakhs. Now government wants to collect 30% of this 50 lakhs as taxes. So let's say, in first case, we will say all this 30% of money government is taking purely as taxes. So what happens? 30% of 50 lakhs is 15 lakhs. This 15 lakhs is tax collected by government. But whatever government is collecting, it is not completely owned by government. Out of this 15 lakhs, it has to give a certain amount to states. So 40% it has to give to states. The 40% that it will give to states will be 2/5 of 15 lakhs. That will come to 6 lakhs. So this 6 lakhs will be going to states. So government, it has in its own pocket how much of money? Only 9 lakhs. So even though government is collecting 15 lakhs from this transaction, it is only able to spend 9 lakhs. It is only able to have 9 lakhs with it. So let's take another scenario where government, instead of charging entire 30% as taxes, it will charge 20% as tax and remaining 10% as surcharge. So in this case what happens is, this 20% will come out to be 10 lakhs and this 10% will come out to be 5 lakhs. So instead of collecting entire 15 lakhs as tax, in this case what government has done is, it has collected 10 lakhs as tax and 5 lakhs as surcharge. This 10 lakhs is again shared with states. So how much is shared with states here? If you see, 40% will go to states, that is 2/5 will go to states. So here 4 lakhs will go to states. And how much is left over? 6 lakhs. But out of this 5 lakhs, central government will not share any amount with states. So whatever central government is getting, it is keeping with itself. So here 5 lakhs central government is getting. Here 6 lakhs central government is getting. The total money that central government is getting for itself is 11 lakhs. Now compare here, they are getting only 9 lakhs. So in this case they are getting more. So there is a tendency for central government to put surcharges instead of collecting entire money as taxes. Why is that case? Because taxes are to be shared with states. Surcharges will not be shared with states. So in both the cases, tax collected is 15 lakhs only. This is tax collected by government. Here the entire 15 lakhs is collected as taxes, but here the 15 lakhs is collected in the form like 10%, 10 lakhs as tax and 5 lakhs as surcharge. But in this case, the 15 lakhs only government share is, central government share is only 9 lakhs. But in this case, the central government share will increase to 11 lakhs. So this way, central government, what it does is, instead of directly putting entire thing as tax, they will put some surcharge. So we have understood what is tax and what is surcharge. Now we will go to understand what is cess. We can say cess is also a kind of surcharge. Cess is nothing but a surcharge, but cess has a particular purpose. Now what happens is, see, government can decide how to spend the taxes. Whatever taxes they are collecting from you, they can spend in whatever plan they made. Like if they are getting 100 rupees of tax, they can just decide how much to give to agriculture. 9 rupees they will spend on agriculture, 10 rupees they will spend on railways, 11 rupees they will spend on roads. Like that, government can decide whatever they want to do with taxes that is left over to them. After giving the amount of money to states, whatever is left out to them, the government can decide on itself. They will make a budget. In that budget, they will tell how much they are going to spend where. In the similar way, they can, whatever surcharges they are collecting, they have the freedom to spend those surcharges on whatever they want. Like however they want, they can just make a plan and they can spend. But when it comes to cess is collected for a particular purpose. For example, we have education cess. We have Swachh Bharat cess. So these are certain cesses which are collected for a particular purpose. If government is taking this cess, they cannot spend it for anything else. If they are taking cess in the name of education, they have to spend all the money that comes as cess only for education. They cannot spend it for anything else. But when they collect some amount of money as surcharge, they can spend, just like taxes, they can spend it for anything else. So again, let me explain you. This is tax, there is surcharge, and there is cess. First main difference is taxes will be shared with states, but surcharge will not be shared. Cess will also not be shared. So this is the first major difference between tax and surcharge and cess. Surcharge and cess are not shared, but tax will be shared. Even though it is collected by central government, this tax should be shared. A certain amount of it should be shared with state governments. But surcharge and cess are not shared. If you see another difference, tax can be spent to whatever government wants. They can spend for any purpose. Surcharge can also be spent for any purpose. But when it comes to cess, only spent for a certain purpose. So this is the main difference between these three. Tax will be shared with states, other two won't be shared with cess, and cess is collected only for a certain purpose, whereas tax and surcharges are not collected for a certain purpose.